This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Retail read Walmart, Macy's, JCPenney, and Kohl's. What to expect when their earnings are released this week.
A few dings. Why a Wall Street darling may have a little tarnish on its gold seal of approval.
And healthy diagnosis. Is the healthcare system ready for aging baby boomers? The second part of our Aging in America series tonight on Nightly Business Report for Tuesday, August 12th.
Good evening, everyone, and welcome. We begin tonight with more signs that America's economy, while not humming for everybody in all regions and income levels, is nonetheless on better footing than it's been in years. Just today, we learned July's federal budget deficit was down to $95 billion. And 10 months into the current fiscal year, Uncle Sam's yearly budget shortfall hasn't been this low since 2008. On the jobs front, the Labor Department says more people are quitting their jobs. That's actually a positive, since it means they either have or are confident they can get a new one. The Federal Reserve says that the home mortgage market improved last quarter, with banks easing up on lending standards for borrowers with good credit. And to top it all off, the National Federation of Independent Business reports that small business owner optimism ticked higher in July, a good sign as we push through the third quarter.
This week, we'll see if American consumers can keep that optimism on the upswing as some of the nation's biggest retail chains post second quarter earnings. Analysts are hoping for a big turnaround from a disastrous start to the year, with wicked winter weather keeping shoppers at home. So will this quarter be better, and which retailers will stand out? The retail earnings story is a tale of two retails, high-end and low-end. Macy's, which also owns the Bloomingdale's stores, is one of those higher-end success stories. When it reports its quarterly numbers tomorrow, analysts are looking for sales growth of 2.5%. Oliver Chen at Citi likes the stock, even though it's lagged the S&P 500 retail index this year, because he thinks demand for Macy's products is relatively consistent.
I would say that I like cash flow. Cash flow is always fashionable. We're recommending limited brands Macy's. That's the name to think about with less fashion risk.
Another higher-end fashion retailer, Nordstrom, is due to report on Thursday. Nordstrom's 7.5% first quarter growth was an upside surprise, though management has been careful with its full-year guidance. Caution is the common theme for lower-end retailers like Kohl's, JCPenney, and Walmart, all reporting on Thursday. Walmart's U.S. same-store sales dropped last quarter for the first time in almost 3 years. This time around, analysts aren't looking for much in the way of growth, less than 1% for U.S. stores and just above 1% overall. Earlier this year, Kohl's looked set to get a bump from the struggles at JCPenney, but it showed no such gain in the first quarter. Stock watchers will also be looking for any hints on how back-to-school season is going for retailers. Tom Blishock, who keeps an eye on consumers, says mall traffic has been up and shopping baskets a little bit fuller than they've been in the recent past.
The consumer is a bit hardened as to what they select, what they buy, where they buy, how they buy, and the trade-offs today are much more significant than the trade-offs we saw 5, 6, 8 years ago.
Blishock also says the rest of the year is going to be extremely competitive for retailers, which means more discounts and promotions for consumers, but less profits for retailers.
So should some of the retail stocks we just mentioned be in your portfolio? Let's ask Liz Dunn. She's a senior retail analyst with Macquarie Securities. Liz, welcome. Good to have you with us. Susie mentioned some of the companies that are out with earnings on Thursday: Macy's, Penny's, Nordstrom, Kohl, and Walmart. Do you agree with the thesis that among those stocks, the ones that skew to the higher end are the ones that you would favor with your investment dollars?
Absolutely. I think that the low and middle income consumer is really struggling. There hasn't been the job growth or wage growth that we've wanted to see, and certainly it's been worse for that group of consumer. I think the high-end consumer is actually doing okay, and there's a tremendous amount of interest in branded goods that you'd find at a Macy's or at a Nordstrom.
So, Liz, if an investor has, let's say, $10,000 and they want to put new money into some retail stocks, what would be the one stock that you would say is a definite plus and that it's going to go up near term?
Well, I'm an analyst, so I'm hesitant to say anything definite. But if I had $10,000 to invest, I'd invest in Macy's. I think they're gaining share. They've got the right merchandise. They've got very solid promotions. The consumer wants promotions right now. Strong e-commerce and omni-channel strategy. They also have tremendous expense discipline, strong free cash flow. They're buying back stock, paying a competitive dividend. I think it's a great company and at an attractive valuation.
You're neutral on Penny and underperform on Kohl's. Explain.
Yeah, Penny's is in the midst of a turnaround. You know, they are expecting, I'm expecting to see solid comp store sales growth from Penny's, but that's really on the back of last year's disaster. So if you look at it on a multi-year basis, we're still looking at sharp declines. But we should see some improvement in sales and improvement in gross margin. And so I certainly don't want to fight that trend in terms of my rating. Kohl's, on the other hand, well, first of all, they're seeing Penny's take back market share, but they're also seeing market share losses to other channels of retail, the online channel, the mass channel, the off-price channel. Kohl's is kind of stuck in the middle, and I think that their value proposition isn't as strong as it has historically been.
The big elephant in the room is Walmart. I saw a headline today that said that Walmart's going to belly flop on its earnings when they come out on Thursday. I mean, what's going wrong with Walmart?
Well, I don't officially cover the company, so I can't comment specifically on earnings, but I can say they've been cautious. They've sounded cautious on their consumer, and that low-end consumer that's Walmart's consumer is really having the hardest time in this recovery. They're not seeing job growth, they're not seeing wage growth, and that's a challenge. And then they are seeing some cuts to entitlement programs that Walmart benefits from, like programs like SNAP. And so I think that consumer is challenged. I also think Walmart competes really head-to-head with some of the online retailers on price, and there's a lot of price competition right now, and so Walmart is challenged by players like Amazon to really sharpen its pencil when it comes to pricing.
All right, Liz, thank you very much. Liz Dunn with Macquarie Securities.
A real reversal of fortune for one retail stock. Shares of high-end designer Kate Spade spiked higher this morning after posting better than expected quarterly earnings thanks to strong sales of handbags and accessories. It even raised its full-year guidance. But as you can see here, shares plummeted, closing down 25% after warning that gross margins for the year would fall as it faces increased competition.
No steep drops in the major averages today, just little ones. Jitters about Russia's next move in the Ukraine crisis basically had Wall Street investors on edge today a little bit. Dow ended the session 9 points lower. Nasdaq was off 12 and the S&P shed 3. Crude oil prices fell today, closing just above $97 a barrel, West Texas. That snapped a 3-session winning streak, and with good reason. The International Energy Agency cut its forecast for global oil demand, while the U.S. Energy Information Administration said the U.S. produced the most energy in July in 30 years. And those factors turned and pressured energy stocks big time, especially oil and gas production names like Southwestern Energy, Chesapeake, and Anadarko, which were among the market's worst performers today.
A mixed report card on the health of the U.S. economy from the S&P ratings agency. It's keeping its overall assessment of economic risks unchanged, but says some key risk factors for the economy have subsided. The S&P now projects that total U.S. credit losses could decline by as much as $45 billion this year, and that home prices will continue to increase this year as well.
House price gains are slowing. The National Association of Realtors says prices grew 4.4% in the second quarter. That's the slowest annual pace since 2012. While 122 out of 173 metro areas posted gains, only 19 markets saw double-digit rises. That's half as many as in the first quarter. The total number of sales slackened too. Slower price gains, of course, good news for buyers trying to break into the market. The most expensive market in the country, by the way, San Jose. Median price, $899,500.
Wow. You buy a couple of Teslas with that. Still ahead, shares of Tesla closed at a record, but will a not-so-glowing review of its Model S dent its reputation? That's next. Some good news for farmers. The U.S. Agriculture Department is now forecasting record-breaking harvests this autumn for corn and soybean crops. That put a lot of pressure on grain and soybean prices today. Soybean and wheat futures fell more than 1%. Corn futures rose a bit because even though a record yield is forecasted, the outlook is slightly below expectations.
There was pressure on shares of Tesla today, but the electric car maker still managed to close at a fresh all-time high. That's despite the fact that Consumer Reports magazine, which gave Tesla's S model glowing reviews last year, now says it has found some minor problems with the car.
Whether or not it's a small problem or a big problem, it's an inconvenience. And you want to buy a car these days, you almost expect the car to be problem-free. And there's many cars you can buy that are like that. So it's going to be very interesting with Tesla as the time goes on.
So how bad are the problems, and should drivers and investors be concerned? Phil LeBeau joins us now from Chicago with more on the knock on Tesla, including what the automaker has to say. Phil, that gentleman earlier today said he's had one of these cars for about 15,000 miles, so he's had time to break it in or for it to break.
Well, it's not just him, Tyler. Consumer Reports bought a Model S with the specific idea being, let's drive it for a year, as anybody else would drive it, and let's see what people think. And it was a number of members of Consumer Reports driving the Model S, and the minor problems that they encountered were things like the door handle, which is flush with the frame of the vehicle. It's supposed to come out when you approach the vehicle so you can open the car. Well, it wouldn't come out a couple of times, so they had to call Tesla. Tesla then would do an over-the-air software update, which then allowed them to open the vehicle. One time, the center console went blank, so they had no controls for the vehicle. They then had to do a hard reset for the Model S. Are these issues that stopped the people at Consumer Reports from driving the vehicle completely for days on end? No. And every time, Tesla responded by fixing what was under warranty and getting the vehicle to operate as it should. However, these are nagging issues that were brought to the forefront by Consumer Reports, and it raises the question of, if I'm paying $90,000, Tyler, I want that vehicle to perform flawlessly and not have nagging issues. So that's what the issue is going to be over the next couple of months as we see these reviews come in.
You know, Phil, exactly. You don't want your car on the side of the road when you're spending that kind of money. But are these, from the way you're sounding, I mean, are these just growing pains? Is it really something much more serious than that?
No, I think it's growing pains. You're talking about a company that has increased production from basically, 22,000 last year. It'll be over 35,000 this year. It'll be by the end of next year over 100,000. And as you ramp up production, you're going to have occasionally these problems that will pop up, especially with a new vehicle. So this is what we're seeing, growing pains.
All right. Thanks a lot, Phil. Phil LeBeau reporting from Chicago. Well, you can call this the IPO that wasn't, after its stock had been trading for 6 sessions on the NASDAQ. An Israeli-based biotech company called Vascular Biogenics announced that it wasn't issuing shares after all. That means all the investors who bought or sold stock in the company since it began trading now have nothing to show for it. The company blames a key investor's failure to follow through on a commitment to buy shares for the cancellation of the initial public stock offering.
Schlumberger, I just love saying that company's name, says it is starting to feel the pain of U.S. and European Union sanctions on Russia, and that is where we begin tonight's market focus. The world's largest oil field services provider said third-quarter earnings could be lower by as much as 3 cents a share. That's because penalties are restricting the engagement of people and equipment in its Russian operations, so says the company. That sent shares of Schlumberger down 1% to $107.87. Boeing has been selected, along with United Technologies' Sikorsky unit, to build prototypes of helicopters for the U.S. Army. The first flight of the chopper is expected in 2017. The value of the contract not disclosed. Boeing shares down slightly despite the news to 120.47. Shares of UT also fell a fraction to 104.91. The mortgage servicer Ocwen Financial warned that it might have uncovered material weakness in its accounting methods in a regulatory filing. The company said it would restate financial statements for the last year and the first quarter. Because of the issues, the stock down about 5% to $25.16. And Dendrion tumbled to its lowest level ever after it warned that there is a significant risk that it will not be able to repay debt that is maturing in 2016. The drug developer said it's considering alternatives to repaying the debt including options that leave shareholders with little or no equity in the company. Shares of the small cap stock plunged about 34% today to $1.40.
Insys Therapeutics saw its shares climb on better than expected second quarter earnings. The drug company said its cancer pain treatment helped bolster the results. The stock was up nearly 5% to $31.85. Exact Sciences got the okay from the Food and Drug Administration to sell its home colon cancer test, the first of its kind to be cleared by regulators. Colon cancer is one of the most common forms of cancer in the U.S., and this test gives patients another option for screening. The stock popped 2% to $17.46. And King Digital, the maker of the popular Candy Crush Saga game, got crushed in after-hours trading today. The social and mobile game maker reported earnings that met forecasts, but sales were below estimates, and the company lowered its full-year outlook. It blamed weakness in Candy Crush sales. After the bell, shares initially plunged by more than 20%. You can see it right there. During regular trading, shares were up slightly to $18.20.
An update now on the troubles for the struggling gambling mecca, Atlantic City in New Jersey, and the fate of its newest, glitziest casino. No qualified bidders came forward in the bankruptcy auction for the 2-year-old Revel Casino. It cost $2.5 billion to build, and since it opened, it never has managed to turn even a quarterly profit. The Revel will shut its doors September 10th and will be at least the third casino to fold in AC this year.
It might sound like something right out of the Jetsons, but it's real and it's here right now. One of the world's top hotel chains has begun using robots to deliver items like towels or toothbrushes right to your room. So does this mean robots will be taking away jobs from hotel workers? And how will it change the hospitality industry? Josh Lipton reports.
From factory floors to driverless cars, the idea of robots taking over human tasks isn't new. In fact, one study from the University of Oxford says nearly 50% of U.S. jobs are at risk of being replaced by computerization. But here at Aloft Hotels, the company's parent, Starwood Hotels, says it isn't looking to eliminate staff, but rather assist them with the help of this guy. This is the very first bottler. Its name is Alo. The idea of the bottler is to take time-consuming jobs off the hands of front desk staff, like sending items up to guest rooms, so the staff can instead spend a lot more time being attentive to guests' needs and requests in person.
From an efficiency standpoint, it gives us much more efficiency, and it really allows our talent members to do what they're here for, which is to serve our guests.
The robot itself is designed by startup Savioke, which has received funding from the likes of Google Ventures. But even the company's CEO thinks robots can actually only do so much.
Robots can do simple things pretty well, and they can do them reliably and over, but they're not going to do like all the things that a person can do. So robots aren't like going to replace people, but they can basically be a productivity tool.
This is just a pilot program, but Starwood Hotels hopes to roll out these robots to nearly 100 locations around the world. And as costs of sensors inside the robot comes down, the idea becomes more affordable.
It's going to come in at, fraction, a few $1,000s will be, in that kind of range. It's not going to be hundreds of thousands. It's not going to be multiple tens of thousands of dollars.
Good job. As robots become more prevalent in day-to-day life, the question remains, do you have to tip them? For Nightly Business Report in Cupertino, California, I'm Josh Lipton.
I would tip them. They look kind of cute. To read more about Josh's story and how Starwood Hotels is using robots, go to our website, nbr.com.
And coming up, the impact baby boomers will have on the healthcare system as they age and what some of the biggest players in the industry are doing to meet their needs. The second part of our series, Aging in America, is next.
It looks like it's finally sinking in. More Americans understand that they have to save now to pay for their retirement later. A new survey by Fidelity Investments shows that nearly half of current U.S. workers say that if offered, they would prefer to have lower pay now in return for a higher employer contribution to their 401k retirement savings account.
A lot of people enrolled in one of the Affordable Care Act's insurance plans may need some of that extra money. Premiums on state health care exchange plans will rise by a forecast average of 7.5% next year. This according to a study by a division of PricewaterhouseCoopers. The highest proposed rate increase came in Nevada, where Time Insurance Company enrollees may see premiums rise 36%.
While the health insurance industry adjusts the cost to consumers in the second year of the Affordable Care Act, we continue our four-part series called Aging in America. In part 2 tonight, we look at the impact of what a rapidly aging population would have on the U.S. healthcare system. Meg Terrell has our story.
For the next 15 years, the baby boomer generation will turn 65 at a rate of about 10,000 every day. And with older age come more health issues, conditions like high blood pressure, heart disease, arthritis, and diabetes.
It is estimated that over 90% of seniors have at least one chronic disease. In fact, 77% have 2 or more.
And the pharmaceutical industry is responding. There are more than 430 medicines in development for the top 15 chronic diseases affecting seniors, according to the industry group Pharma, more than double the number 10 years ago.
There's no question that diseases that affect the elderly around the world actually are the fastest growing and some of the most difficult problems in the healthcare system. And of course, we believe medicines and biopharmaceuticals can make a difference for those patients.
Dave Ricks leads the biomedicines unit at drug maker Eli Lilly. He said much of the company's research is focused on medicines for the aging, a shift from in the past.
I think the science and the study of diseases of the elderly has in fact increased, and therefore our ability to look for new medicines in that space have coincided with this underlying market demand in the elderly aging population.
One area, though, remains particularly challenging: Alzheimer's disease. The medicines currently on the market address just the symptoms rather than the underlying cause, and the industry has seen several high-profile failures, including from Eli Lilly. Still, Lilly and others continue to work in the space. The number of medicines in development has tripled from a decade ago. That's as more than 36 million people worldwide have dementia, a number only expected to grow without intervention.
And the swelling number of seniors will put pressure on healthcare costs. The number of Medicare beneficiaries is expected to rise from about 52 million now to more than 80 million in 2014. And costs are expected to rise accordingly, from about 3.5% of GDP now to 5.6% in 2040. For Nightly Business Report, I'm Meg Terrell.
Tomorrow, as we continue our series, Aging in America, we look at some of the companies that stand to benefit as the population grows older.
Finally tonight, something that's gone viral. It's called the Ice Bucket Challenge for ALS, known as Lou Gehrig's disease. And here's how it works. People videotape themselves getting a bucket of ice water dumped on their heads. They then post it on social media and challenge someone else to do the same, or they have to donate money to an ALS charity. Watch.
3, 2, 1.
And Meg Terrell got it too. Today, top executives and researchers at Biogen IDEC, a Boston area firm at the forefront of finding a cure for the degenerative disease, took the challenge, and the National Office of the ALS Association says, and this is really good news, it's received $2.3 million since the end of July, 10 times what it took in over the same period last year.
Poor Meg, but that's one of the requirements. When you're a pharmaceutical reporter, you've got to have the ice bucket.
Got to go
Part
for
two. That's Nightly Business Report for us. I'm Susie Garrett, and we want to remind you that this is the time of year your public television station seeks your support.
We sure do. I'm Tyler Matheson on behalf of your public TV station. Thanks for your support, and we'll see you back here tomorrow.
I'm Susie Garrett with a Nightly Business Report news brief. Optimism about the U.S. economy is on the rise thanks to a string of positive trends. A sharp drop in the federal budget deficit in July, a more than 13-year high in job openings in June, the Fed reporting banks have eased up on lending standards, and a rosier forecast from the nation's small business owners. But jitters about Russia's next move in Ukraine had Wall Street investors on edge. The Dow fell 9 points, the Nasdaq down 12, and the S&P off by 3 points. Oil prices fell along with forecasts for global oil demand, and the U.S. produced the most oil and gas in July in 30 years. And a new survey from Fidelity funds nearly half of U.S. workers would sacrifice higher pay now for a bigger contribution to their 401k savings. Be sure to tune into Nightly Business Report right here on your public television station.